Picture this. You're in a multi-billion-dollar business where the product you sell, a piece of titanium, is literally becoming as common as a nail in a hardware store. Most investors think the big medical giants are safe bets, but we've spent months digging into the 2026 data at HDIN Research, and let me tell you, some of these titans have a hole in their pocket the size of a crater. Today we're deconstructing why the old way of selling healthcare is dead, and who's actually winning the race for the future. Here's the cold truth. The $80 billion orthopedic market is no longer about who has the best metal, it's about who owns the brain. In 2026, if you're just selling hardware, you're fighting for scraps. Look at the shift. 75% of high-margin surgeries are now quote-unquote bot-controlled. The robot isn't just an assistant, it's the gatekeeper. If your robot isn't in the operating room, your implants aren't going in the patient. Period. So who owns the playground? It's still the big three. Stryker, J&J, and Zimmer. They're sitting on mountains of cash, pulling in nearly $30 billion combined. To put that in perspective, that's enough to buy every single person in Manhattan a high-end designer watch, twice. But don't let those big bars fool you. The smaller guys like Globus and Alphatec are moving fast, and they're hungry. Now here's where it gets messy. We call this the pricing scissors. On one hand, everyone is getting older, so more people need new knees. That's the 11% volume growth. Sounds great, right? Wrong. In markets like China, the government is essentially saying, we love your tech, but we're only paying 15% of the old price. It's like selling twice as many burgers, but making 80% less profit per burger. That's a recipe for a heart attack, not a business. So how do you survive when the price of your product is falling off a cliff? You stop selling stuff, and you start selling results. We're seeing a massive pivot from selling hardware to buying outcomes. This is where the winners separate themselves from the losers. Let's look at the MVP Stryker. Their Mako robot is basically the iPhone of the operating room. Once a hospital buys the robot, they're locked in. They buy 20% more of Stryker's specific implants because, well, the robot doesn't play nice with other people's metal. It's a brilliant high-tech trap that ensures Stryker stays at the top of the food chain. Then there's Johnson & Johnson. They're doing something radical. They're cutting their orthopedic arm loose. Why? Because they want to be lean and mean. They're shedding the corporate weight to go after the high-speed tech stuff. It's like a massive ship launching a speedboat so it can actually turn around before hitting an iceberg. But then we have Globus. They just swallowed their biggest rival, NuVasive. On paper, they look like a beast with a 16% revenue jump. But here's the catch. Merging two giant sales teams is like trying to host a dinner party for two families that hate each other. If they can't play nice, that $2.9 billion revenue is going to start shrinking fast. While the giants are fighting, look at Alphatec. These guys are growing at 25%. They aren't trying to do everything. They just do spine, and they do it differently. Their PTP approach is so specialized that they're stealing the most complicated and expensive cases right out from under the noses of the big guys. And don't ignore the niche players like SI Bone. They've built a quote-unquote regulatory moat. They've basically convinced the insurance companies that their specific surgery is the only one worth paying for. When the government says we only pay for the best and you're the only one on the list, you've basically won the lottery. Time for a reality check. Let's look at the leaderboard. Stryker is the safe bet with a rock-solid balance sheet. Alphatec is the high-octane growth play, but they're burning through cash like a bonfire. You have to ask yourself, in a world of high interest rates, who still has enough grain in the silo to survive the winter? This is the most important chart in the deck. It's the margin waterfall. We start with a healthy 75% profit, but then the scissors we talked about start cutting. China takes 10%, the US takes 5%. But look at that blue bar, digital premium. That's the money made from software and AI. Without it, these companies are just commodity metal shops. Warning, there is a $5 billion ghost haunting this industry. It's called goodwill. Basically, these companies paid a premium for their acquisitions, and if they don't perform, that value vanishes. We're already seeing top surgeons leaving because they hate the new management. If the talent walks out the door, the billions they paid for those companies might as well be burned. So where are we headed? By late 2026, J&J will be independent, Mako 4.0 will be everywhere, and we might even see the first truly autonomous surgery bots. The message for 2026 is simple. If you aren't selling efficiency and outcomes, you're just selling scrap metal. This is a brutal, fast-moving game. If you're an investor or a healthcare leader who needs to know exactly where the next blow is coming from, you need the full data. Reach out to us at HDIN Research. Don't just watch the market change, own the change. I'm from HDIN, and I'll see you in the next deep dive.